Have you ever stared at your bank account and thought, there has to be a better way to make my money grow than just letting it sit there? You hear all these fancy terms thrown around: mutual funds, ETFs, index funds, hedge funds, and it sounds like a secret language for the super rich. But what if I told you that understanding these isn't rocket science? And what if unlocking this knowledge is the key to building real wealth? Stick around, because today we're demystifying these investment giants. We're staging the ultimate battle of the funds, and by the end of this video, you'll know exactly which one could be your champion on the path to financial freedom. Let's start with the OG of the fund world, the mutual fund. Imagine you and a bunch of other people all want to invest in the stock market, but you don't have millions of dollars or the time to pick individual stocks. So you all pool your money together. A professional fund manager then takes that giant pool of cash and invests it in a diversified portfolio of stocks, bonds, or other assets. It's like a potluck dinner for investing. Everyone brings a little something, and a pro chef, the fund manager, turns it into a magnificent feast. The main idea here is active management. You're paying a professional to actively buy and sell investments, trying to beat the market and get you the best returns possible. This hands-on approach is great for beginners who want an expert in their corner. However, this expertise comes at a cost, usually in the form of higher fees known as expense ratios. We'll talk more about those fees later, because they can really eat into your profits over time. Next up, we have the cool modern cousin, the ETF, or exchange-traded fund. Think of an ETF like a mutual fund that got a tech upgrade. It also holds a collection of investments like stocks or bonds. But here's the game changer. ETFs trade on a stock exchange, just like a single stock. This means you can buy and sell them throughout the day, and their prices fluctuate constantly. Mutual funds, on the other hand, are typically priced only once per day after the market closes. This flexibility is a huge draw for many investors. It's like being able to order a single slice of your favorite pizza anytime you want, instead of having to wait until dinner to buy the whole pie. Many ETFs are passively managed, meaning they simply aim to track a specific market index, like the S&P 500. Because there isn't a team of managers actively trying to outsmart the market, ETFs often have much lower fees than mutual funds. This combination of flexibility, low cost, and diversification has made ETFs incredibly popular in recent years. Now, let's talk about the silent powerhouse in this battle, the index fund. An index fund is a type of mutual fund, or ETF, with a very simple, yet powerful strategy. It doesn't try to beat the market. It tries to be the market. How? Buys all, or a representative sample of the stocks in a specific market index. For example, an S&P 500 index fund will hold shares in all 500 of the largest U.S. companies. The legendary investor Warren Buffett is a huge fan of index funds for the average person. Why? Because it's a set-it-and-forget-it approach. You're not betting on a single manager's genius. You're betting on the long-term growth of the entire market. And historically, that's been a pretty good bet. The biggest advantage of index funds is their rock-bottom costs. Since there's no active management, no high-paid analysts, or constant trading, the fees are minimal. This passive approach means you get broad market exposure for a fraction of the cost of an actively managed mutual fund. It's the ultimate low-maintenance, high-potential investment for long-term growth. Finally, we enter the velvet-roped, exclusive VIP lounge of the investment world, the hedge fund. You've probably heard about these in movies, often associated with billionaires and high-stakes drama. And honestly, that's not too far from the truth. Hedge funds are private investment partnerships for accredited wealthy investors. They are hedged because they use complex strategies to try and make money whether the market goes up or down. They can invest in almost anything: stocks, currencies, real estate. You name it, and often use aggressive techniques like short selling and leveraging borrowed money. The goal is to generate high returns, or alpha, regardless of market conditions. Think of it like a special forces team of investing, using unconventional tactics to achieve their mission. However, this exclusivity and complexity come with a hefty price tag. Hedge funds are notorious for their high fees. It's often structured as 2 and 20, a 2% management fee on assets, plus 20% of any profits. For the vast majority of us, hedge funds are out of reach and not really relevant to our personal finance journey. But it's crucial to know what they are and why they are in a league of their own. So let's put it all together. What are the key differences? The first is management style. Mutual funds are typically actively managed, meaning a pro is making decisions. Index funds and most ETFs are passively managed, simply tracking an index. Hedge funds are hyperactively managed, using complex strategies. The second difference is trading. You can trade ETFs all day like stocks, while mutual funds are priced and traded only once per day. The third is cost. This is a big one. Index funds and ETFs generally have the lowest fees. Actively managed mutual funds are more expensive, and hedge funds. They're in a completely different universe of high fees. Finally, there's accessibility. Anyone can invest in mutual funds, ETFs, and index funds, often with very little money to start. Hedge funds, on the other hand, are exclusive clubs for the ultra-wealthy. Understanding these four pillars, management, trading, cost, and accessibility, is the key to choosing the right vehicle for your money. So, the million-dollar question, which one is right for you and can make you richer? The truth is, there's no single best fund. The right choice depends entirely on your personal financial goals, your risk tolerance, and how hands-on you want to be. If you're a beginner and want a professional to manage your money, and you don't mind paying a bit more for that service, an actively managed mutual fund could be a good starting point. You're essentially outsourcing the decision-making to an expert. If you value low costs, flexibility, and want to build a diversified portfolio that you can trade like a stock, ETFs are an incredible option. They offer the best of both worlds, the diversification of a fund and the trading ease of a stock. If you believe in the long-term power of the market and want the lowest possible costs, the index fund is your champion. It's a simple, proven strategy for building wealth over time by simply riding the market's growth. For most long-term investors looking to build a retirement nest egg, this is often the most recommended path. And the hedge fund, for 99.9% of us, it's more of a financial curiosity than a practical option. Unless you have millions to invest and a very high tolerance for risk, you can safely leave this one to the Wall Street gurus. Ultimately, getting richer isn't about finding a magic bullet. It's about consistency, time, and keeping your costs low. For many people, a simple, low-cost index fund or ETF is the most reliable vehicle for that journey. You get broad diversification, you benefit from the overall growth of the economy, and you don't lose a significant chunk of your returns to high fees. The real secret isn't picking the perfect fund, but starting to invest, staying consistent, and letting the power of compound growth do its magic over the years. Don't let the complexity of these terms scare you away. You now have the fundamental knowledge to start making informed decisions and take control of your financial future. Thank you so much for joining me in this battle of the funds. Hope this cleared things up and gave you the confidence to start your investment journey. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe and hit that notification bell so you don't miss our next video. What other financial topics do you want me to break down? Let me know in the comments below. See you next time.